Welcome to Breaking News to Trading Moves. We are looking at the headlines and figuring out exactly who wins and who loses in the market. Today, we have a very specific story to look at regarding pretty much everyone's favorite subject.
Yeah, it is hard to go wrong with pizza.
Yeah.
But specifically today, we are looking at Domino's Pizza. They just reported earnings, and the reaction was, well, it was immediate. The stock popped right away in early trading.
Right. And usually when a stock moves like that, there is a clear, identifiable story behind it. With Domino's, it seems like we actually have a split personality in this report. On one hand, you have the U.S. performance, which absolutely beat Wall Street's expectations. But on the other hand,
The international numbers, yeah, they were lagging. It is a
yes,
classic case of domestic strength versus international weakness. And what makes this report really worth analyzing for you guys listening isn't just the raw numbers themselves.
it's the why.
Exactly. It's the specific reasons why that U.S. segment performed so well. It all comes down to the current consumer environment we are operating in right now. It's really all about this value trade down.
We are seeing that term pop up a lot lately. Consumers are just feeling the pinch everywhere else, so they are trading down to cheaper options. And Domino's seems to have positioned itself right in the center of that pattern.
They really have. They're leaning heavily into menu innovation and some very aggressive price points. So our mission today is to look at the Domino's report, understand the strategy driving that U.S. growth, and then broaden our scope.
Right. We are going to look at which sectors and specific stocks are winning because of this trend and which ones might be in real trouble. We have a solid list of tickers to get through today, so definitely get your notepads ready.
Let's start with the star of the show, though, which is the U.S. performance.
Yeah, what exactly did Domino's report that got the market so excited right out of the gate?
So the headline metric here is U.S. same-store sales growth. For the fourth quarter, they came in at 3.7%. Now, that number matters because it beat the expectations that analysts had previously set.
And in this environment, beating expectations on top-line sales growth is a very positive signal.
Absolutely.
And 3.7% is a solid, healthy number for a mature, massive chain like Domino's. But what actually drove it? Was it just people deciding to eat more pizza, or did they do something specific to bring those people in?
It was very specific. The report explicitly credits two main drivers for that bump. First is the value proposition. They've been running this $9.99 deal that has clearly resonated with customers.
$9.99 is such a powerful price point. Psychologically, it just feels so much cheaper than $10. Even if it is literally just a penny difference, your brain registers it as a single-digit meal.
Precisely. And in a time where grocery prices are up and sitting down at a traditional restaurant is way up, a $9.99 deal to feed yourself or part of your family is a really strong draw.
What was the second driver they mentioned?
The second driver was menu innovation. They launched a Parmesan-stuffed crust.
Oh, I saw that. Stuffed crust is pretty much always a crowd pleaser.
It is, and strategically, it gives your existing customers a reason to order again. Or maybe it gets them to spend a little bit more on that premium add-on while still feeling like they are getting an overall deal.
So you combine a strong, reliable value offer with a new, tempting product that people want to try, and boom, you get that traffic bump.
Exactly. You get the 3.7% growth.
Okay, so that is the backward-looking number. But markets trade on the future. Did management give us any clues about where they see things going from here?
They did. They provided guidance for fiscal 2026. They are projecting roughly 3% U.S. same-store sales growth.
So they are expecting to stay in that steady, consistent growth range.
Yes, but there is a nuance to the timing that you have to pay attention to. They imply that the first half of the year is going to be stronger than the second half.
Okay, so a front-loaded year.
Right. And that is something traders watch closely because it sets the bar for the next couple of earnings reports. If they are front-loading that growth, we need to see them execute right away early in the year. If they stumble in Q1, the whole yearly projection is in jeopardy.
That makes sense. So the U.S. is the good news. But we mentioned the international drag earlier. What exactly happened over there?
Yeah, this is a caution flag in the report. International same-store sales were only up 0.7%. That missed estimates.
That is a pretty stark contrast. 3.7% in the U.S. versus just 0.7% internationally.
It is a totally different picture. And they cited specific weak spots, too. Australia and Japan were called out directly as places where they are seeing a lack of consumer demand and a lot of competitive pressure.
Japan is notoriously a tough market for foreign fast food to maintain dominance in. And Australia has a ton of local competition too, right?
They do. And what this shows us is that the value strategy working so beautifully in the U.S. might not be translating perfectly to every single market. Or it could just be that the economic pressures in those specific regions are weighing even heavier on the consumer over there.
Before we move on to the broader market implications, there is one more strategic piece of the Domino's puzzle I really want to touch on. It's Domino's and delivery. Because historically, they have been fiercely protective of their own internal delivery network. But that changed recently, didn't it?
It did, and is a major factor here. The partnership with DoorDash. They are now using third-party apps for what they call delivery as distribution.
Meaning they're using the DoorDash app essentially as a marketing funnel to get the order, even if a Domino's driver might actually fulfill it.
In many cases, yes. The key concept here is access. By being prominent on the DoorDash app, they get in front of customers who might not have the dedicated Domino's app installed on their phone. It is all about incremental reach.
Right, capturing the people who are already browsing.
Exactly. The report highlighted that this partnership is lifting order frequency and really helping with customer acquisition. If you are a hungry customer scrolling through DoorDash trying to figure out what you want and you see that $9.99 deal pop up, you might switch from your usual $20 burger order to pizza.
That makes total sense. It is all about reducing friction for the buyer. If the customer is already opening DoorDash out of habit, you need to be there too.
You have to be where the eyeballs are. So that is the core Domino's story right now. You have U.S. strength driven by value and menu innovation. You have some international weakness, and you have this very successful strategic pivot to third-party delivery apps.
Now let's widen the lens a bit. You mentioned earlier that this is a trade-down tape. What exactly does that mean for the broader market?
The current environment for restaurants is completely defined by the consumer's wallet right now. People are feeling squeezed, inflation has been sticky, everyday costs are high, and disposable income is being watched very, very carefully.
So they aren't stopping eating out entirely, but they are changing how they do it.
Exactly. Consumers are actively hunting for value. They want bundles. They want predictable pricing. They do not want to go sit down at a restaurant and be shocked by the final bill when they factor in drinks, an appetizer, and a tip.
So the thesis here is that Domino's isn't just winning because their pizza suddenly tastes better, but because their price point is exactly right for this moment in time.
The thesis is that Domino's can win market share through a combination of three distinct things: deals, speed, and digital presence. And if that thesis holds true for Domino's, it has massive implications for the rest of the restaurant sector.
It sets a precedent.
It does. It suggests a pattern where value-focused quick-service restaurants, or QSRs, and the delivery platforms that service them are going to benefit. Meanwhile, the higher-priced dining options are going to lose traffic.
Let's get into the winners and losers then. Based on this thesis, we have three categories of winners to look at. First up is Category 1, value-first QSR and pizza chains.
This category is all about brands that can drive traffic via deals without absolutely destroying their profit margins in the process. The market is actively rewarding companies that can defend their market share while discounting. Domino's results prove that value promos are working right now to get people in the door.
So obviously, Domino's is in this bucket. The ticker is DPZ.
Correct, ticker DPZ. If the strategy is working this well for them, they are the primary play in this category.
Who else fits in here?
You definitely have to look at Papa John's, ticker PZZA.
Ticker PZZA.
Right, because if pizza is the category of choice for the trade-down consumer, simply because it feeds a whole family cheaply, Papa John's is going to benefit from that exact same tailwind.
Makes sense. A rising tide lifts the whole pizza boat.
Exactly. And then you have the absolute king of QSR value, McDonald's.
Ticker MCD.
Ticker MCD. McDonald's is pretty much always the benchmark for value in the fast food space. They really are. When consumers are stressed and looking for a reliable deal, McDonald's is often the very first stop. If the data from Domino's shows that a $9.99 price point is winning, McDonald's various value bundles are likely seeing similar traction. The market tends to re-rate these brands higher when they prove they can keep traffic flowing even when the consumer is stressed.
Okay, so that covers the food side of the equation. What about the logistics side? You mentioned DoorDash was a key partner for Domino's. That brings us to Category 2 of the winners, food delivery and last-mile platforms.
Right. This goes back to that concept of delivery as distribution. As more restaurant partners lean heavily on third-party apps to generate their order volume, these platform companies win. Domino's explicitly called out their reach expansion as being tied to DoorDash.
So the main ticker here is DoorDash, ticker DAS.
Ticker DAS, yes. And we also cannot forget Uber Technologies, ticker UBER, specifically for their Uber Eats division.
Ticker UBER. Got it.
When restaurants are pushing these value promos, they need an efficient way to distribute them to the masses. These delivery platforms are the modern marketplace. If a customer decides they cannot afford to go out to eat, but they still want restaurant food, they open these apps.
So increased volume for Domino's via the app directly signals potential volume increases for the platforms themselves. It's an ecosystem play.
Precisely. If the value-focused restaurants are busy fulfilling delivery orders, the delivery platforms are busy making money on those transactions.
Let's move to category 3 for the winners. Discount and value-centric operators.
This category broadens the scope a bit, beyond just pizza and burgers. These are the direct, everyday beneficiaries of the trade-down. Think about it. If you are not going to a sit-down place on a Friday night, where do you go? You go somewhere with a lower overall check average.
We are looking at Wendy's here, right? Ticker WENU.
Ticker WA, yes.
Yeah.
Wendy's is famous for their biggie bag and other bundled value combos. That is exactly what the budget-conscious consumer is hunting for right now. A complete meal for a fixed, low price.
And Jack in the Box as well, ticker J.
Ticker J. It is a very similar dynamic there. These operators thrive when consumers are actively substituting away from more expensive meals.
It is so compelling how the market segments this out. It isn't just a broad restaurants are up or restaurants are down scenario. It is laser focused on the specific price point.
It has to be. The consumer behavior is extremely specific right now, and the market is just reflecting that reality.
Okay, let's flip the coin. If value, discounts, and delivery are winning, who is on the losing end? Let's talk about the losers. Category 1, premium fast casual.
This is the exact flip side of the trade-down pattern. Fast casual sits in this awkward middle ground. It is definitely more expensive than traditional fast food, but it is cheaper than a full sit-down restaurant.
But in an economic squeeze, being in the middle ground can be a dangerous place to be.
Very dangerous. So we are talking about names like Chipotle, ticker CMG.
Ticker CMG. Now, Chipotle is objectively a very strong company, but
If promo-driven QSRs are capturing that wallet share with $9.99 deals that feed two people, a $15 or $16 burrito bowl and drink combo for one person at a fast casual spot starts to look pretty expensive.
right, they might see softer traffic as people opt for the cheaper pizza, or they might be forced to start discounting their own food, which immediately hurts their profit margins.
Exactly. And another one in this category is Shake Shack, ticker SHAK.
Ticker SH. Same fundamental issue there.
A premium burger and a shake is a great product, no doubt about it, but it is a discretionary spend. If the family budget is tight this week, they might opt for the cheaper bundle at a traditional drive-thru instead of paying up for the premium ingredients and experience.
It really is a battle for the occasion. If you only have the budget for one night a week to eat out and you watching your cash, you go where the deal is.
You go where your dollar stretches the furthest.
Let's look at category 2 of the losers. Casual dining and sit down.
This category is taking a hit from the dinner at home, but not home-cooked trend. If people are ordering delivery pizza on a Tuesday, they are explicitly not going out to a sit-down restaurant.
So we are looking at Darden restaurants here. Ticker DRI. They own Olive Garden and Longhorn Steakhouse.
Ticker DRI. When consumers want something cheap, fast, and delivered right to their door, sit-down dining just loses those occasions. When you factor in the tip for the server, the travel time, the higher prices for drinks, it all adds up to a much higher bill.
And Brinker International as well. Ticker ET. They own Chili's.
Ticker EAT. Chili's competes directly for that casual weeknight dinner occasion. If Domino's is winning on pure convenience and a lower price, Brinker is facing a real headwind.
It seems like the actual experience of dining out in a restaurant is what gets cut first when household budgets tighten up.
It is the easiest lever for a consumer to pull. You still get to eat restaurant-quality food, which feels like a treat, but you strip out the service cost and the higher menu markups by ordering QSR delivery instead.
Lastly, category 3 for the losers. Internationally exposed brands.
This brings us all the way back to the red flag in the Domino's report, that international miss.
So we are talking about Starbucks. Ticker SBUX.
Kicker SBUX. They have massive widespread exposure to markets like China and Japan. If a brand like Domino's is seeing notable weakness in Japan and Australia, it serves as a data point suggesting the consumer in those specific regions is just not spending freely right now.
And Yum Brands. Ticker YUM. They own KFC, Pizza Hut, and Taco Bell globally.
Ticker YUM. It is a very similar profile. The Domino's miss internationally acts as an early warning sign for the rest of the sector. Investors might decide to stay cautious on these chains until they see hard proof that those international comps have actually stabilized. If the global consumer is pulling back, these large multinational brands are going to feel it.
Okay, so we have the full landscape laid out. Value wins, premium struggles, and the international side is shaky. How do we actually turn this information into action? Let's look through the trading lens. What are the clear strategies here based on the data?
Based on this news, there are three main ways to view the market going forward. First is synthesis. You want to carefully watch the relative strength in ticker DPZ and the other value operators versus the premium fast casual names.
So you are saying you literally watched the charts of DPZ versus a chart of CMG?
Yes. If DPZ holds up well or even rallies while CMG lags behind, that actively confirms the trade-down thesis is playing out in real time. You generally want to be long the value winners and cautious or even short the premium players in that specific scenario.
Got it. What is strategy two?
Strategy two is to keep a very close eye on ticker DASH and ticker UGER. Specifically, look at them during broader, market-wide risk-off dips.
Why specifically during dips?
Because if the fundamental read-through from this Domino's report is that their delivery volume is going up because of the trade-down pattern, then a general market dip might give you a much better entry price on a stock that actually has a strong fundamental tailwind behind it. If the delivery thesis sticks, these stocks should outperform over time.
That makes a lot of sense. And strategy three?
Strategy three is to be very wary of internationally exposed names. If we see another earnings report from a different global brand that also mentions weakness in places like Australia or Japan, that confirms a wider pattern.
So if you see weakness in SBUX or YMM earnings, that echoes exactly what Domino's just said. It completely validates the trend.
Exactly. It moves from being a single company's execution problem to a sector-wide macroeconomic theme.
It really is fascinating how one single earnings report from a pizza company can give us vital clues about everything from tech stocks like Uber to coffee stocks like Starbucks.
That is the beauty of analyzing the market. Everything's interconnected. The consumer's simple decision to buy a $9.99 pizza instead of a $15 burrito tells us a whole lot about the broader macroeconomic picture.
So to wrap this up, we have a very clear picture of the current consumer. They are hungry, but they are calculating. They want the stuffed crust, but they want it at a discount.
And they want it delivered.
And they want it delivered. It brings us to a final thought for you to take away today. We often talk about these trends like they are temporary adjustments to inflation. But ask yourself this, is the movement to value and delivery just a temporary budget fix? Or are we witnessing a permanent change in how families eat dinner? Once you get used to the convenience and the lower price of delivery apps and value menus, do you actually go back to the sit-down restaurant when you finally have a little more cash in your pocket? Or has the habit just changed for good?
That is the billion-dollar question for the entire hospitality industry right now.
Indeed it is. Before we sign off, a quick reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Do your own research.
Always.
Thanks for listening to Breaking News to Trading Moves. We will catch you on the next headline.
See you next time.